Most people believe markets send clear signals. Prices go up when something is scarce, down when it isn't. That belief works well enough most of the time, which is why it becomes dangerous when conditions change. Right now, silver is doing something that breaks that simple logic. Prices are being pushed lower, yet physical metal is disappearing faster than it has in years. Those two things should not coexist for long, and when they do, it usually means one side of the market is lying. Let's start with what actually happened, not what it's being called. Official exchange data from Shanghai shows that in a single trading day, roughly 15% of the silver stored in exchange vaults was removed. Not transferred between categories, not reclassified, removed. That kind of drawdown doesn't come from speculation or sentiment. It comes from someone taking possession of metal they don't intend to give back. When inventory leaves the system that quickly, it tells you urgency has entered the equation. At the same time, pricing is sending a mixed message. Western spot silver has been hovering in the low 70s, while silver inside China has been trading several dollars higher, with futures pushing even further. That creates a premium of roughly 3.5% to 5% for silver traded in Shanghai versus New York or London. On paper, that may look small. In physical commodity markets, it is enormous. A sustained premium like that does not exist by accident. Here is where the false comfort trap appears. Many investors assume arbitrage instantly corrects these differences. They believe metal will simply flow until prices equalize. That assumption only holds if metal is free to move and if holders are willing to sell it back into the market. Quietly, both of those conditions are failing. This brings us to the first mechanism you need to understand, and it's simple. A regional premium acts like gravity. It pulls physical supply toward itself. If you can sell silver for 5% more in one market than another, the flow becomes one-directional. Metal moves toward the higher price. Over time, that drain becomes visible in inventories, even if paper prices refuse to acknowledge it. Now add industrial behavior to that picture. China's demand for silver is not driven by investors or traders, it's driven by factories. Solar panel manufacturing alone consumes tens of millions of ounces annually. Electric vehicle components require millions more. These industries don't respond to price drops by pulling back. They respond by accelerating purchases. Lower prices reduce costs and allow them to secure future supply. To them, price weakness is not a warning, it's an opportunity. This is why falling prices and shrinking inventories are occurring simultaneously. Physical users are not waiting for confirmation from charts. They are locking in metal because production lines do not run on futures contracts. They run on delivery. Every ounce they remove from vaults is an ounce that cannot be used to settle someone else's promise later. The third force tightening this structure is regulatory, and it's easy to underestimate. Since the start of this year, China has implemented stricter export licensing rules for refined silver. These are not symbolic. They materially slow the ability of silver to leave the country once it enters. The result is asymmetric flow. Silver can move into China relatively easily. Getting it back out is far more difficult. Put these three forces together and the structure becomes clear. Industrial demand is accelerating. Regional premiums are pulling in global supply. Export restrictions are trapping that supply once it arrives. Silver flows inward and stays there. Inventories drain, but prices set elsewhere fail to respond because they are dominated by paper trading rather than physical settlement. This matters because global silver pricing is still anchored to Western futures exchanges, particularly COMEX. Those prices influence mining revenues, investment products, and perception. But they are built on a system where the vast majority of contracts never result in delivery. That system functions only as long as most participants are willing to accept cash settlement or roll their positions forward. That willingness is not guaranteed. It's psychological. It depends on confidence that delivery is always possible if desired. Recently, that confidence has started to crack. Delivery rates on futures contracts have surged well beyond historical norms. In some periods, nearly all open interest has stood for physical delivery instead of rolling. That is not how this system is designed to operate. Here is where the delayed risk enters. COMEX registered silver available for delivery sets just over 100 million ounces. Total open interest across silver futures represents more than 4 times that amount. Historically, this imbalance has been manageable because only a small fraction of contracts ever demand metal. But March delivery periods tend to see higher physical demand due to industrial procurement cycles. At the same time, registered inventories have been declining daily, not building. This creates a fragile equilibrium. The system relies on most participants choosing not to test it. As long as they don't, everything appears stable. The moment enough participants decide they want metal instead of exposure, the arithmetic stops working. History doesn't need to be repeated to be instructive. In past commodity stresses, the pattern is consistent. Physical demand tightens quietly, inventories thin, prices lag because leverage and liquidation dominate short-term behavior. Then, suddenly, confidence shifts, not because of a headline, but because participants realize the assumptions they relied on no longer hold. Second-order effects begin to appear before price reacts. Exchanges raise margin requirements to reduce leverage. That forces selling, often pushing prices lower even as physical scarcity worsens. This confuses observers who assume lower prices mean weaker fundamentals. In reality, it often means the opposite. It means leverage is being flushed out of a system under strain. We are in that phase now. Paper markets are attempting to reassert control through liquidation and margin pressure. Physical markets are signaling urgency through withdrawals and premiums. These two realities can coexist temporarily, but not indefinitely. The most important thing to understand at this stage is that nothing dramatic needs to happen for this structure to fail. It doesn't require default or panic. It only requires a shift in preference, a quiet decision by enough participants that owning the metal matters more than holding the promise. As we move closer to the next delivery window, the question is not whether silver is useful or whether demand exists. Those answers are already obvious. The real question is whether the current structure can absorb continued physical withdrawal without forcing a repricing or a change in the rules. Because once rules start changing, confidence never returns to where it was. When confidence starts to thin, institutions behave very differently than the stories they tell the public. They don't announce fear. They manage exposure. They don't predict collapse. They quietly prepare for instability. In the silver market, that preparation is already visible, and it's happening in ways that don't show up on price charts until much later. One of the clearest signals is how exchanges themselves are acting. Margin requirements on silver futures have been raised repeatedly within a very short window of time. This is not routine housekeeping. Exchanges raise margins when they see elevated risk of disorderly moves, counterparty failure, or cascading liquidations. It's a defensive move designed to slow the system down before leverage turns volatility into something more dangerous. What makes this more revealing is the imbalance in how different metals are being treated. Silver margins have been raised more aggressively than gold, despite both markets experiencing volatility. That tells you where stress is perceived to be higher. Exchanges don't respond to narratives or sentiment. They respond to exposure. When silver is targeted more heavily, it's because the positioning there is more fragile. Higher margins force a choice. Traders must add capital or reduce positions. Weak hands are flushed out, not because fundamentals changed, but because they can no longer afford to stay in the trade. This process often pushes prices lower temporarily, reinforcing the illusion that demand is weakening. In reality, it's leverage that's being removed, not interest. While this is happening on the paper side, the physical side continues moving in the opposite direction. Vault reports show ongoing withdrawals of silver that are not being replaced. This is not metal shifting between registered and eligible categories for accounting purposes. It is metal leaving the system entirely. Once removed, it no longer supports futures delivery. It no longer underpins the paper structure. This is where second-order effects become critical. As inventories thin, leasing markets tighten. Lease rates rise because holders are less willing to lend metal, even short-term. They understand that replacement risk has increased. When lease rates climb, it signals that physical availability is becoming constrained, regardless of what spot prices suggest. Industrial users respond to this environment very differently than financial traders. For a manufacturer, volatility is not an opportunity, it's a threat. If you operate a solar panel factory or an electric vehicle supply chain, you cannot afford to wait and see if metal will be available later. Production schedules don't adjust to futures curves, they require certainty. As a result, procurement strategies shift. Companies extend inventory coverage from weeks to months. They negotiate long-term contracts directly with refiners and miners. They secure supply at fixed terms and remove it from the spot market entirely. Every ounce locked up this way becomes invisible to exchange statistics, even though demand has increased. This is why visible inventories can collapse without an immediate price response. The metal isn't being bid up in open auctions. It's being quietly absorbed through contracts designed to bypass volatility altogether. Paper markets don't see this demand directly, but they feel its absence over time as available supply shrinks. Regulatory behavior adds another layer to this picture. When exchanges identify and act against coordinated trading activity, it signals concern about market integrity. Official actions restricting linked accounts or limiting position sizes are not taken lightly. They imply that activity crossed from aggressive speculation into destabilizing behavior. Importantly, regulation can slow paper excess, but it cannot create physical supply. It can change how contracts trade, but it cannot refill vaults. This is a hard boundary. No amount of rulemaking can manufacture metal on demand. When physical scarcity emerges, regulation can only manage the symptoms, not the cause. History offers uncomfortable lessons here. In past commodity crises, exchanges have chosen stability over strict adherence to contract terms. Cash settlement has replaced delivery. Trades have been canceled retroactively. Rules have been rewritten midstream. These actions preserve the system in the short term, but they permanently alter trust. Once participants experience a market where delivery becomes conditional, behavior changes, hedging strategies evolve, counterparty risk is reassessed, physical ownership becomes more attractive relative to paper exposure. This shift doesn't happen overnight, but it compounds. Central bank behavior reinforces this broader trend. While silver itself is not a primary reserve asset, sustained accumulation of gold by central banks reflects institutional skepticism toward paper claims. When official entities steadily convert reserves into physical metal over long periods, they are signaling a preference for certainty over yield. Historically, periods of heavy gold accumulation have coincided with structural stress in monetary systems. Silver often lags gold initially, then reacts more violently once confidence shifts. That relationship doesn't require crisis. It emerges naturally when trust in financial intermediaries weakens. Correlation dynamics complicate the picture further. Silver has increasingly traded alongside other risk assets during periods of stress. When liquidity dries up, everything gets sold. This includes assets with improving fundamentals. Forced liquidation overwhelms underlying demand, creating temporary distortions that confuse observers. These distortions are psychologically difficult. They reward liquidity and punish conviction. They make fundamentals feel irrelevant, but they are not permanent. Forced selling ends when leverage is gone. Physical demand does not disappear simply because price fell. When selling pressure exhausts itself, the imbalance becomes visible. Geopolitical uncertainty adds fuel to this dynamic. Rising tensions increase demand for cash first. Participants sell what they can, not what they should. Precious metals are often caught in this initial wave. But history shows that once immediate liquidity needs are met, attention shifts toward assets with no counterparty risk. Silver occupies an unusual position here. It is both an industrial input and a monetary hedge. That dual role increases volatility, but it also anchors demand. Industrial users cannot simply stop buying. Monetary participants may step aside temporarily, but they rarely abandon the asset entirely. This brings us back to structure. The silver market is functioning because most participants still behave as if delivery is optional. Futures contracts are treated as financial instruments, not claims on metal. That assumption allows leverage to exceed physical backing by multiples without immediate consequence. What we are witnessing now is not a breakdown, but a test of how much strain the system can absorb before behavior changes. Each margin hike, each inventory withdrawal, each regulatory action tightens that test. The most revealing moments are not the headlines. They are the small adaptations. When traders reduce position size not because of price, but because of risk. When manufacturers increase inventory not because of fear, but because of prudence. When exchanges intervene not because of fraud, but because of instability. None of this guarantees an imminent outcome. Systems can endure imbalance longer than logic suggests. But endurance is not the same as health. Direction matters more than timing. Inventories are trending lower, margins are trending higher. Physical demand is ignoring price weakness. That combination tells you something fundamental is shifting beneath the surface, even if the surface itself still looks calm. When systems reach this stage, the most important changes don't happen in price. They happen in expectations. Participants stop asking what should happen and start asking what could go wrong. That shift is subtle, but it changes behavior in ways that are difficult to reverse. In the silver market, this is the phase where confidence doesn't collapse, but it quietly relocates. A useful way to think about what's unfolding is to separate belief from function. The paper silver market functions because most participants believe delivery is optional. They trade exposure, not metal. The moment that belief weakens, even slightly, the function of the market changes. Contracts stop being abstract instruments and start being evaluated as promises that might need to be honored under stress. This is why constraint matters more than narrative. Paper supply has no natural limit. Contracts can be created as long as there is someone willing to take the other side. Physical silver, by contrast, is constrained by mining output, refining capacity, logistics, and time. These constraints don't respond to sentiment. They don't accelerate because price is suppressed. They assert themselves regardless of what futures curves imply. When you view the market through that lens, many recent signals make more sense. Rising volatility alongside falling inventories is not contradictory. It's a sign that leverage is being shaken out while physical demand remains intact. Margin hikes are not bearish judgments. They are defensive responses to instability. Regulatory intervention is not reassurance. It is acknowledgement that normal behavior is breaking down. Another practical mental model is to watch where optionality disappears. Optionality exists when participants have easy choices. They can roll contracts, source metal later, or rely on intermediaries without concern. Optionality disappears when replacement risk increases. When metal is hard to source, when delivery timelines stretch, when conditions are attached to fulfillment, optionality shrinks. This is already visible in how physical holders behave. Metal that once circulated freely is being held more tightly. Leasing becomes more expensive. Long-term contracts replace spot purchases. These are not emotional decisions. They are rational responses to perceived scarcity. Each decision makes the next one easier, reinforcing the trend. The paper market, meanwhile, attempts to restore balance through price and leverage. Liquidation creates the impression of resolution. Lower prices suggest excess supply. But that resolution is temporary if it is achieved by forcing financial players out rather than increasing physical availability. Once forced selling ends, the underlying imbalance reasserts itself. This is why timing is so deceptive. Markets can look weakest just before they become structurally stronger, not because conditions improved, but because pressure was redistributed. Weak hands exit, strong hands remain. Physical demand continues quietly in the background. There is also an institutional dimension that often goes unnoticed. Clearinghouses and exchanges are not neutral observers. Their priority is system continuity. When stress rises, they adjust rules to protect the system as a whole, even if that means altering individual outcomes. This creates a hierarchy of interests that participants must account for, whether they like it or not. History shows that when markets reach this point, outcomes tend to be asymmetric. Upside and downside risks no longer mirror each other. On the downside, forced liquidation can push prices below levels justified by fundamentals. On the upside, resolution can come suddenly once confidence shifts, because supply cannot respond quickly. Silver's dual role intensifies this asymmetry. As an industrial input, demand does not vanish when prices fall. As a monetary hedge, interest can return rapidly when trust erodes elsewhere. That combination creates periods of suppression followed by abrupt repricing, not because sentiment flips overnight, but because constraints finally dominate behavior. Geopolitical uncertainty amplifies these dynamics. In uncertain environments, participants initially seek liquidity above all else. Cash becomes king, even if it is not trusted long term. But once immediate needs are met, attention turns back to assets that sit outside the financial system. Physical metals benefit from that shift, but only if they are actually obtainable. This brings us to the uncomfortable core of the issue. Modern commodity markets are built on the assumption that most claims will never be exercised simultaneously. That assumption is held for decades because incentives align to make it true. What happens when incentives change? When holding the asset becomes more attractive than holding the promise? That change doesn't require panic. It can happen through quiet recalibration. A manufacturer increases inventory targets. A fund reduces reliance on derivatives. A trader chooses delivery over rollover. Individually, these choices are rational and unremarkable. Collectively, they reshape the market. What often surprises people is how little volume is required to tip a leveraged system. Because paper claims are so large relative to physical backing, a relatively small increase in delivery demand can have outsized effects. The system doesn't fail gradually. It bends, adapts, and then responds in ways that feel sudden to those watching only the surface. This is why focusing solely on price can be misleading. Price is an output, not a cause. It reflects the balance of pressure at a moment in time, not the underlying state of the system. Flow data, inventory trends, and institutional behavior often tell the story earlier, but they require patience to interpret. As delivery periods approach and inventories remain thin, the market faces a series of choices rather than a single verdict. Incentives can be adjusted, rules can be modified, settlement can be encouraged through means other than metal. Each choice resolves immediate stress while altering future expectations. The long-term consequence of repeated adjustments is not collapse, but adaptation. Participants learn where the boundaries are. They learn when promises become negotiable. They learn how the system protects itself. That learning changes behavior permanently. For observers, the challenge is resisting the need for a clean answer. Markets rarely provide one. Instead, they offer a sequence of signals that only make sense in retrospect. The silver market right now is sending those signals quietly. Physical withdrawal, rising premiums, defensive regulation, elevated margins, persistent industrial demand. None of these alone proves anything. Together, they describe a system under strain, not breaking, but adjusting. The outcome of that adjustment will not be decided by belief or commentary. It will be decided by constraints and choices made under pressure. So the question to sit with is not whether silver should be higher or lower, or whether a particular delivery month will succeed or fail. The deeper question is this: if confidence in paper claims continues to erode just enough to change behavior, but not enough to cause panic, how does that reshape the market over time? Because the most profound shifts in markets are rarely announced. They emerge when participants quietly decide that certainty matters more than convenience, and that decision, once made, is very hard to reverse.